Hi guys, welcome to the session. I'm just going to check the stream is running correctly because I've made some changes on the back end of how this is getting pushed out. I'm essentially running it to both Darwinex and Darwinex Zero today, doing a couple of different tests. So I'm just going to check that it's all running smoothly before we jump in, and also give everybody a moment to join the session too. Okay, looks good on Twitter/X. YouTube. Okay, all looks good. Okay, here we go. People are joining. I have sent a link into the Discord as well. So give everybody a moment to join. Today's session is going to be all about strategy development, as we usually do on a Wednesday, where we take a look at somebody's Darwin. We go into the good, the bad, the ugly, everything that we have from both Darwinex and Darwinex Zero perspective to see if there's any low-hanging fruits for somebody to improve their trading strategy. So I think there was somebody yesterday, risk 1%. Hopefully they're in the session now. How are we doing, BOFH? I mean, good morning. to me, it's afternoon, but understandably, we have people all around the world. So good morning, good afternoon, good evening, good night, wherever you are. We have a couple of people based in Australia who at the minute will be kind of like midnight, 1 a.m. JCID will probably pop up at some point because he's a night owl and likes watching these sessions early morning like an absolute sicko. So yeah, hopefully risk 1% is in the audience today. If not, I'm happy to take somebody else's Darwin and do kind of a live analysis. If you haven't been to one of these sessions before, I love diving into different variables. So the whole goal of this session is not to look at charts, not to look at things that you already look at on a daily basis as a trader, right? It's to explore different variables. So what I always say is, the majority of traders, especially these days, right, with the rise of businesses like TradingView and different charting tools, with the rise of influencers who, you know, sell courses and try to paint a strategy as being the one way to get profitable, and usually it's just kind of you know, a pattern on a chart or something to that effect. People's strategy becomes solely based on that. Right, they see a pattern and everything gets sort of like a revolving door around that specific pattern. So I see ABC, I'm going to do XYZ. And what they tend to do is ignore all of the million variables that come into play when you're trading the market. For example, times, market conditions. I mean, there's so many to go into, which we will go into as we go through this session. And it's really about bringing those sort of metrics and those variables to light so that you can improve your trading strategy moving forward. Okay. The goal of every trader every single day should be, how do I get that 1% better today? It doesn't matter if it's a big revelation. You don't have to get super profitable overnight. You don't have to do anything crazy. But if we can figure out areas or certain things that you're, you know, that's holding you back, or certain things that you do well that you can double down on, that's all we ask for in this session. So if anybody is in the audience now who wants their Darwin to be analyzed, I'm happy to use a live example. If not, we can use a random one. We can use mine. But I know there's usually somebody here who wants their Darwin analyzed. So I'll give everybody a moment to kind of put their hand up. Just drop it in the comments section, whatever platform you're watching this on, and we can get started. A little bit of background about me as well, because I always, especially today, now that we're streaming on Darwinex as well as on the Zero end of things, a little bit of background about me, so you know who's kind of leading this conversation, right? Before I become a trader, I was a data analyst. So I love looking at metrics. I love looking at kind of unbiased statistical information and trying to formulate patterns from those. It's difficult to do so, but with time, you start to recognize patterns of behavior early on from kind of numbers and different patterns in statistics. I then become a trader about 7 years ago, started discretionary trading, had quite a bit of success as a trader, but I also had, you know, really, really lows. Yes, I will take a look for you in a moment about your VAR. And about 6 months ago, I switched everything up. I dropped all of my discretionary trading and I become a fully fledged algorithmic trader. On the screen, you can see XAQP, which is my personal main portfolio. This is a portfolio of 27 strategies, all running with a max drawdown of, or max historical drawdown of 1%. I run it at very low risk at master account level, meaning I get scaled up quite significantly at Darwinex. But this is my record, right? So you know who I am and what I'm about. You know how I trade. You can see my performance. You know, I am a trader and I'm also a data analyst. So when we put all those together, I just love doing these sessions, right? Because it combines all the stuff that I enjoy doing and what I like to look at. Wait until next month for SPWL. Hi, Lol. Sorry. How are we doing, Rob? I missed you actually this week. I don't think you haven't been in the streams yet. Let's take a look at SPWL. I haven't looked at it this week, so. Okay, looking good. Holding steady. Holding steady. It's looking good, mate. It's very, very similar to mine. 25.4, 23.4. Yeah, very, very similar. So Michonne said, there seemed to be an increase in my value at risk since July. Not sure why. If you could share some insight as to why. Could you send your Darwin in so I can take a look at it? Without taking a look, it's hard to see. I mean, it'll be hard for me to see why anyway. I can give you certain reasons as to why it may have increased, but I'd like to kind of know what we're looking at here. But in short, the different factors that affect your value at risk is the volatility of the assets. Here we go. VNWQ. Oh my love, I can't even type today. WQ. Okay, so it's still fairly low, but yeah, it's pretty much doubled since January, February. So I mean, I always try and put this into perspective for people. To a lot, you know, people would go, oh well, it's still low, it's still only 6%, but to you who had a 3% value at risk, this is 100% increase, right, to 6%, which means your risk multiplier would have halved in that time. Now, the four main factors that affect value at risk is asset volatility. So if the asset that you're trading has significantly increased in volatility, then yes, your value at risk will increase. It wouldn't have caused a 100% increase in VAR, I would presume. Okay. Number two is the trade frequency. Again, it's very difficult for the frequency of trades to spike your value at risk by basically 100%. It can be a contributing factor to that. So if you've stepped up your frequency of trades, for example, if you've stopped doing one trade a week and now you're doing one trade a day, or you've stopped doing one trade a day and now you're peppering 10 trades a day, of course, you're taking more in market exposure and therefore your value at risk is going to be higher. Same thing with trade duration. If you've started holding your trades for a lot longer period of time, that can spike your value at risk. Those three things I don't think would give you 100%. Okay, you've taken some indices positions. What were the other assets that you trade? So you have indices, FX, commodities. Only 3 trades on indices. I don't know. I mean, potentially that might be, again, it might be a contributing factor because especially the DAX is a lot more volatile than, let's say, Euro dollar or Euro Aussie or any of these FX pairs. But when we look at that and you've only got 3 trades, I don't think it would cause such a spike in value risk. My question would be, what's your position sizing been like over the past few months? Have you increased your position sizing since, when was it that we saw the big spike? So mid-July. And when I say position sizing, I guess that's also asking if you started adding indices into your strategy as well. Were you using roughly the same sort of risk? Because position sizing is the one that has the most dramatic effect on your value at risk, right? If you start doubling your position size, then guess what? Your value at risk is pretty much going to double. So that would be my main question. If you haven't changed your position sizing, then yeah, we could put it down to a increase in frequency of trades if you've added another asset and the fact that it's more volatile. But I presume Okay, still 1% risk across the board, but I didn't trade indices before. Okay, the only thing with that, and this is where it gets a little bit more difficult to sort of determine, is we can't necessarily measure exposure based on how much percentage risk you take per trade. It has to be on, physically the amount of size you have in the market at that point. So if you're trading indices, which is a higher volatility asset, for example, but you're trading it with roughly a smaller stop than you do on FX, which would mean you therefore, if you're still risking 1%, you would have a larger position size when it comes down to the notional value compared to a euro dollar position, for example, then yes, your value at risk would spike higher. What I mean by that, because I understand that's probably a little bit wordy and quite confusing, is your 1% risk on euro dollar compared to 1% risk on the DAX can be completely different from a notional value perspective if we compare the two. Better than the worst. Good morning. How are we? Hope you're all good. Hi, Kieran. If there's nobody else, please check JKTN. Yes, we can go through JKTN because nobody else has stuck their hand up. So, well done to you for getting involved. JKTN. JKTN. Welcome to all the guys on Darwinex, by the way, because like I say, this is the first time that we've started streaming on Darwinex. I'm just doing it as the reason being was because until now, everything was branded Darwinex 0, even the background on the stream. And so I kind of kept them separate. And then I thought, you know what? I don't know why we have this segregation between 0 and classic for the streams. If we're talking about strategies, talking about Darwinex, let's include everyone, right? So I've changed it all to say Darwinex TV so that we're not discriminating from classic traders or 0 traders. So welcome to everybody who's joined. I can see there's been a big ramp up in viewers over the past couple of minutes. For the guys who've just joined, the whole purpose of this session is to go through people's track records, to take a look if there's any variables that we can kind of exploit or improve on moving forward. So we take a look at things outside of charts or, fundamental data or anything that might be strategy related. And we take a look at more variables that perhaps you wouldn't necessarily look at. Great. I love Darwinex Tech 100 making me some cash today in its late lovely crash. I mean, I'm long on the NASDAQ, so we're kind of fighting against each other here. It's actually super frustrating if I pull it over a sec. So this was, I've been in this since yesterday, I believe. When was the entry time that? Yeah, 16th. So yeah, yesterday, you see the target was right here. Skirted the target late yesterday. I'll say late yesterday, it was 12 p.m. And then, yeah, just sold off and now it's collapsing again. My stop's down here. So it doesn't look good, but it is what it is. I've actually had a fantastic month. So I don't mind taking a couple of losses. My performance at the minute is way above the mean of kind of what I expect anyway with my portfolio. So I'm more than happy to take a couple of stop outs because let's bring that back down. Okay, so let's take a look. So beginning pretty much start of the year. So you started at the 30th of Jan. So we're taking, I mean, how many months is that? My mental maths isn't great, right? I'm good with statistics and stuff, but my mental maths is absolutely awful. Yeah, I mean, if I can stay in the NASDAQ till tomorrow, then fantastic. But yeah, I'm close to my stop, then I'm my target now. So that's the way I always determine things, especially now I'm an algo trader. I'm like, am I closer to target or closer to stop? Whichever one I'm closer to, that's where I'm like, yeah, we're heading that way. Okay, so we won't clash Jan as a full month because you started pretty much at the end of January. So we've got Feb, March, April, May, June, July, August, September. So we've got 8 months. So I presume you're going to be going into DarwinIA Gold next month, perhaps? Bang on. Okay, so you've got a 2.5 return to drawdown ratio. So you should be getting promoted to DarwinIA Gold next month, if I'm not mistaken, which is absolutely fantastic. Like, my hat off to you. For those of you who are watching who doesn't know what DarwinIA Silver and DarwinIA Gold is, it's basically our monthly leaderboard. It has every single trader on our platform. So you can see in DarwinIA Silver at the moment, there's 8,880 traders. And then in DarwinIA Gold, there is, definitely the wrong thing to press. DarwinIA Gold. I'm currently ranked number 7th out of those 8,800 traders. I'll have you know as well. That's my little flex for this week. DarwinIA Gold, there is 348 traders. So with DarwinIA Silver, what we do is we run it as a monthly leaderboard. Any trader with a rating of 75, you can see the rating down here. Any trader with a rating of 75 or above will gain an allocation for that month. With that allocation, you can then earn performance fees. The way we calculate that rating is we take a look at your current month's return, your previous 5 months return, and your previous 6 months drawdown. Okay, with those figures, we give you a rating. In DarwinIA Gold, we don't use the same rating. We just base it on who's made the highest return for that month. To get to DarwinIA Gold, where you become open to investor capital, you become open to the index and the Darwinex Labs proprietary fund, and also larger allocations, you have to have a minimum 8-month track record. You have to have at least a 20% return, and you have to have a minimum return to drawdown ratio of 2.5x. What that means is if you have a 10% drawdown, you would need a 25% return. If you have a 20% return, you would need like an 8 point something percent. I think you're pretty much on the mark here. So like you're just over 20%. So you need roughly an 8.5% drawdown to be promoted to gold. If it's above that, you would have to wait till your return exceeds it. So effectively, I mean, that's a lot of words for me to say that effectively your return needs to be over 2.5 times your max drawdown. Rosendo, hello, how are we doing? I just started a few months ago. She's one of my 3 Darwins, SFYD. Awesome. We'll take a look at SFYD if we have time afterwards, but I'm glad you're here. One of your 3 Darwins. So you've jumped in at the deep end, right? I mean, even I've got 3 Darwins. So yeah, it's good to have you here anyway. Okay, 21.8% year to date. Fantastic return. Managed drawdown. I mean, sorry if you can hear my dog. She's at the bottom of the stairs and she kicks off whenever somebody walks past the house. Pretty stable equity curve other than right here, right? But I'm presuming this is something strategy related that you've kind of worked on, because since then the drawdowns haven't been as harsh. We tend to get that as well. Like that's a common pattern that I see at Darwinex. What I see moving forward for a lot of traders whose record is like a year or 2 in length is the equity curve begins to stable out as the trader realizes how important their record is. Okay, so at the beginning, when they're just starting out their record, they'll be a little bit more volatile. They'll do certain things that potentially they won't do in a couple of years' time when they know that people are watching what they're doing. And therefore, you see these steeper drawdowns and you see them testing things out. And then over time, things just stabilize when they realize, okay, this actually means something now. I've got 6 months, 8 months, 12 months worth of data, and this can do something for me long term. Which is good. You've had a recent bump, which is fantastic. Currently managing 95,000 euros. So well done to you with a positive return of September for 3.28%. So pretty much you've been positive since back in April, which I presume was that dip that we were talking about anyway. Oh, I've just had a notification, something that should be going out soon. Okay, let's move on to assets and timeframes. So the first sort of variable that I like to take a look at is what you actually trade. Okay, I'm not bothered about the strategy you have. I'm not bothered about the timeframes that you trade on, any of that sort of stuff. That to me is all noise. I'm agnostic to how you trade. All I would like to know is, do you trade manually or do you trade algorithmically? I'm presuming that you trade manually because you're part of Tradersaurus Rex, which is Alb's tribe. And I don't think he has too many algorithmic traders. Also, your trade frequency doesn't look like exactly manually. Okay, cool. So it's good to know. And the reason I ask that is because the feedback I give differs massively between a discretionary trader and somebody who trades with algorithms. There's certain variables that with algorithms just don't represent the same sort of things. For example, if we're talking about times of day when you're executing, it's harder to give feedback on that for an algorithmic trader because the signals might pop off at random times of day when the trader's asleep, right? So certain things like that is more difficult to comment on. So it's good to know you're a manual trader. They are much, much easier. So we have 150 trades, pretty much 50% of your effort goes into FX, 111 trades on indices, and 55 trades on commodities. Now, already what I can see here, which is one of the biggest things that I look at, is what is the efficiency of your asset allocation? Okay. And what I'm 2 seconds. Sorry about that. She's having a go at someone walking past the house. So I thought I'd get her up here so she doesn't disturb us anymore. Okay, so I look at the asset allocation efficiency, essentially. And what I mean by that is how much are you being rewarded for your input to that specific asset? And again, this is usually more relative to a discretionary trader, because algorithmic traders often put hedging mechanisms in or certain strategies that hedge against periods of time. So I'm not going to go into that into too much detail. But for you, I presume you have a setup, you look on multiple assets, and you execute the same or the similar setup pretty much 90% of the time. Now, what we want to know from that is, what is my expected value trading FX? What's my expected value trading commodities? And what's my expected value trading indices? Okay, I don't even know. Is that stock in ETFs? Yeah, so you've had one trade. We can ignore that one. So if we take a look at your commodity CFD trades, so you've had 55. I love that. So clearly you're a Lance Breitstein fan, looking for the broken slot machine. That was, I mean, I believe it was coined by Lance. I used that a lot last year and a couple of years ago when I was writing articles and stuff in terms of like hunting for that broken slot machine. And Lance says it fantastically, how every day, not every, relating the market to a casino, if you will, not every slot machine is going to pay out. It's your job as the trader to find on that specific day which slot machine is broken and which one is going to pay you out. I mean, every day, week, hour, depending on how frequent you trade. But what's interesting here is if we take a look at commodities versus FX, you've taken 3 times the amount of trades on FX as you have on commodities. You haven't got too much data, but 55 and 150 is a pretty good start. Now, if we take a look at the return, you can see on those 55 trades, you've netted 7.73%. Whereas on the 150 trades on FX, you've only netted 2.91%. So the efficiency is far, far, far lower on FX. In fact, like 3 times less, but you've had 3 times the amount of trades. Now, you can look at this and go, well, I'm still positive on FX, so it's not as if it's a bad thing. And I tend to agree. However, and maybe this is just me where I'm at in my life, right? Is I look at trading as, how can I do the least amount of effort for the most amount of output or reward, essentially? And what I would be looking at is, if I have, as you say, the slot machine that is consistently paying out over time, which would be in this case the commodities when you're executing on gold, compared to executing on FX. If I know that my payout per trade is far, far higher on gold, I could strip a lot of my workload, in fact, 50% of my workload, and focus only on what is my high performing assets. That's quite an extreme value. I'm not recommending that you drop trading FX, but what I'm saying is you can be creative here. You can implement something that I like to talk about quite a lot in these sessions, which is a risk barometer, where we figure out the exact expected value based on the assets, the time of day, the day of the week, and all of these different things. And you score your trades on a risk barometer, dependent on where it scores. So, for example, if it's your highest returning asset, which would be commodities, it'd be indices, but again, based on the expected value divided, so the return divided by number of trades, your expected value is actually higher on commodities, I think. Pretty sure. Again, my mental math is not my sharp point, but I'm pretty certain that's the case. So we can go, okay, commodities is your highest performing asset. So that moves up the slider on the risk barometer. Okay. Whereas FX is right down the other end. Okay. So the risk barometer at its baseline can be 1. And I don't just mean 1%. I'm not saying it as a percentage per trade. I'm just saying it's a baseline of the factor of 1 or 0, whatever number that you want. I usually use 1. Then if we know that we have a higher expected value, we can move that slider up to 1.1, 1.2, 1.3. I'm not on about tripling your risk. I'm not on about going all in because we have a higher expected value. But what I'm talking about here is leaning into your edge when you know it has a higher chance of playing out. And also still executing on the trades that are lower in quality, if you will, but taking your foot off the gas slightly. Allocating different weights, if you will, into the portfolio of your trading. So, for example, on FX, you might slide the risk barometer down to 0.8 or 0.7x of the baseline. Again, if that is a 1% in the middle, so if your baseline factor of 1 equals 1%, then maybe you tune it down to 0.7% or tune it up to 1.3%. But that slight variance over an extended period of time, again, talking months, months, years, if not, 5 years, 10 years, that tiny variance can pay off massively because you're leaning into that alpha when it's actually got higher expected value. This goes much further, which we'll get onto in a moment, but okay. Okay, so Andres says, from my experience, I know that if I take out the FX, I will overtrade the commodities, kind of curve fitting, meaning it actually may not improve my results from taking out FX. Could be wrong. Interesting idea, just reducing the size for FX. Okay, so that to me sounds more like a you problem than a strategy problem, if I'm gonna put it blunt. Because if I'm reading that right, what you're saying is if you remove FX, you'll feel like you're not doing enough, and therefore you'll probably put more emphasis on taking more trades on, gold or the commodities that you trade, which is kind of a you issue. That's something that you would have to confront head on, where you go, listen, my results would be way higher, my efficiency would be way higher if I just focused on this asset, but carried on doing what I'm doing. So that doesn't mean dropping an asset and replacing that workload with another, same size workload. It means dropping that and focusing on what's working. I don't always agree with that. I say it sometimes because if your return here was minus 10%, I'd be saying, yeah, you need to drop FX. You clearly don't have an edge there. Like it doesn't matter. Just stop trading it. But you clearly do. Okay. So I'm not going to suggest that you stop trading FX at all. I would just say personally, I would be looking at creative ways to implement some form of risk barometer, whether you want to call it that, whether you grade your setups and score them and then allocate risk to them dynamically. And again, I'm not talking about going from 1% risk to 5% risk. I'm saying like 1.2, 1.3, maybe 1.5 at an absolute push. But that gets powerful when we combine it with other variables. You can also break this down by asset, but generally it's gonna sing the same hymn, right? So pound dollar, even 2% return. That's actually quite interesting. So let's take a look. You have Aussie dollar. Okay, so Aussie dollar, euro dollar, pound dollar. So it looks like you trade those quite well, whereas the other pairs is where you're giving it all back. Okay, so your yen pairs, Swissy, New Zealand, pretty much flat, dollar CAD, pound yen. So when we're looking at different FX pairs, I'm sure you're all aware, which I know you all will be, right? But different pairs, different assets, all have their own characteristics inherently baked into them, right? There's different traders, there's different market makers, there's different people behind each individual asset. So they have different natures. For example, dollar CAD might be very commodity heavy. There's different people in power of those two economies than there is on euro yen. Okay, different economies again. Just because they're both FX pairs doesn't mean that they're going to behave in the same way. Yes, they might react to the same key pieces of news or what have you and things like that, but it doesn't mean that they're going to do similar things. The same way that Tesla and Apple stock might do completely different things, but they both react to, retail sales data or unemployment data, for example, in the US, but they do different things. They have different people back in that company, back in that asset class. So I do sometimes break it down if there is data like this where you could go, okay, clearly I have something that works on euro dollar, pound dollar, Aussie dollar. 3 very similar pairs. We know they're similar because half of the pair is exactly the same. It's a US dollar on all 3 accounts. Then euro and pound dollar, there's not too much discrepancy between the euro and pound. Generally, I know we've had Brexit, but generally what happens in Europe affects the United Kingdom. What happens in the UK generally affects Europe to a degree, or at least people view it in that way. So they're very similar. And I've always found, I don't have data to back this up, so I can't say it confidently, but Aussie dollar is probably the next closest. Dollar CAD has a mind of its own. Dollar Swiss is very spiky. I don't like it. But Aussie dollar generally looks very similar to pound dollar and euro dollar. So I'm not surprised that if you have an edge on one, you have an edge on all 3. But I would be looking at this and going, well, my edge is present here, or at least it has been over the past 8 months. Again, as new data comes in, maybe you disprove this theory, okay? And that's fine, which is why I don't think it makes sense to drop it. Just scale back your risk slightly. But does it make sense to drop Aussie, Euro, and Pound when collectively they've made like 7% on their own? Probably not. Okay. But still, you can remove some of the effort that you were giving to your yen pairs. You can remove them from your watch list, cut down the hours that you're spending at your screen, cut down the hours of time given to backtesting these pairs when you don't necessarily need to, because they're not paying out the way that Euro, Pound, and Aussie is. Anyway, I'm getting too lost in that sort of thing. I don't usually spend too long going over the asset allocation. So we'll move on. Trading time distribution. Issue with this, and I usually don't spend too much time on this either, is because this says number of trades, but actually this doubles them up, so it shows trading decisions. And what I mean by that is it will count opening and closing a trade as a individual trade for the purpose of this this metric. So that makes it really difficult to understand where you're closing and opening positions, because we just don't know. It's easier for you because clearly you're not doing anything or you don't have any activity really in the Asian session and on the tail end of the US session. So we know you're very active during European session, but equally that gives us very little things to work on or improve, because we go, well, we don't know what your expectancy would be like outside of these zones, which is fine. We don't need to know, but it gives us very limited information of going, okay, well, after this time, your expected value would be XYZ because we only have 1 or 2 trades. So there's very little I can say on this. Better than the worst said, I dropped all charts except my favorite and did the same thing to an extreme. Really know it all well. Really know it well now. Yeah, that's the thing. I mean, you find a flow on a specific asset, right? And it can be the weirdest thing in the world. Like I've known traders who will trade corn, grain, all these sorts of different things. And then you suggest, oh, why don't you go and trade euro dollar? And they're like, oh, no way. I don't know that market. And these are professionals. And when you start hearing that again and again and again, you kind of realize that actually the guys at the top, they know their markets inside out and they won't go near a market that they don't know at all. It's easier for algorithmic traders, I believe, because you can run tests in a short space of time. Like you can back test a specific market, which doesn't necessarily show you visually how a market moves and its own characteristics, but you can understand if I'm running breakout strategies and it's working really well on dollar yen, but it's not working on euro dollar, I know that potentially that means dollar yen is higher in volatility, because when it breaks out it starts to move. So you can kind of get an idea very, very quickly as an algorithmic trader. As a discretionary trader, it takes months, if not years, of watching the same asset just trade day after day to understand its flow and to get a feel for its flow and to stay in sync. Now, I have 4 screens. My bottom right-hand screen has had a chart on it for the past 7 years, until recently, until I started trading algorithmically. Now it's on my top screen. But I've had a chart open for the past 7 years. So with assets I trade, I can look at them, and I'm not saying I'm going to be right 100% of the time, but when I look at the chart, I kind of know how things are going to play out to a degree, or I know what should play out, whether it moves higher or lower. I don't know. But I know generally, if I'm looking at a chart of euro dollar, I know its average true range in my head based on the visual aspects of the chart because I've watched it for so long. But for the traders who don't screen watch, it takes a little, and I'm not advocating screen watching or chart watching here, but it takes a little bit longer to build up that flow and the sync with the assets that you're trading. I also think you need to understand who the key speakers are, the key monetary and fiscal policies within the economies that you're trading. There's interesting nuances like the DAX, for example. Not many people know or understand that the DAX is very, very, very heavily correlated with the US economic performance. I'm struggling to get my words out here. I need another drink. The reason being is because the majority of the companies in the DAX, their top exports are to the US. Okay, so where they do the majority of their business is in the US, which means if the US economy is, absolutely tanking, well, guess what happens to these German companies? They also tank, which means that the DAX also tanks. So, for example, that is a unique position to be in, I guess, if you know that I'm trading the German stock market, but actually it's heavily correlated with the US economy. Not everybody is going to know that. Okay, but if you put the time and the effort into study your market, you will understand that relationship, and you will know that even is a relationship, right? So I think it's really important to know your market. As better than the worst said, it's really important to feel in flow with that market, and stripping it back and trading less or train less markets doesn't necessarily mean that you're sitting on your hands doing nothing. Sometimes it's the best thing to do. Sometimes to increase performance and increase output, you have to minimize the input. Okay. And I'm not saying like you do less work, you do less input into the task or input into trading, but sometimes less chart time and less actual training can yield greater results. Okay. Something important to be aware of, because especially for beginner traders, it's always, how do I get in more trades? How do I do more? How do I be more? When actually what they should be looking at is, what do I do bad and how can I stop doing that? Yes, a trade 95% USA open only. It would be great if we can see when the opening is. Yeah, let me have a talk to the team, because like I say, I understand why it's laid out like this. In terms of why we show this, I think it would be fantastic if we could have this split into two sections where we could choose open/close, and then whichever you choose, it shows where you open the trades, where you close the trades. Let me have a conversation with the team, because I'm pretty sure that wouldn't be too difficult to incorporate. I'm presuming it would just be a UX UI development, because we have the data on the back end, right? Okay, this is possibly my favorite metric to look at, because there's always a story to tell behind this, and quite often the funniest stories come from taking a look at these metrics. So I work with a lot of traders on a one-to-one basis at Darwinex. So if somebody messages me and says, I need some help, or can you take a look at some metrics with me, I always jump on a call with people, and I always invest time into our traders, because if you don't know, like, or if you've spent 2 years learning how to trade, that might mean that you're still very limited in being able to improve, or having somebody to guide you from becoming from being this kind of retail trader who's just learned a few basic chart patterns, to actually somebody who is still a retail trader, but kind of crosses the border to becoming like a professional retail trader, somebody who treats trading as a career, or even if it's not a career right now, it can be a career in the next 5 to 10 years. So I will always invest time into our traders, and that goes for anybody listening to this now. I will always give time to you guys. If you want to message me and you want to do one of these sessions one-to-one, as long as I'm free and have time, I will always jump on. But I'm going to give you a couple of stories from this, and the guys who come to these sessions on a weekly basis will have heard these stories a million times over. But I always find them really funny. I always find them really unique, and it kind of shows my point here, is that your return distribution by day of the week effectively measures how much return you generate on those specific days. But I always think this splits into two different sections. We have the strategy specific stuff. So just categorically, some strategies work better on certain days than others. Some strategies perform worse on certain days than others. For example, a trend following strategy, if anybody does their research on certain data points, they will know that if we have a bullish week, so let's say euro dollar moves up for the week, I'm just using this as a base example, the lower the week, the highest percentage chance is that it's going to be on a Monday or Tuesday. I don't know the statistics off the top of my head, but I have them in a spreadsheet somewhere. But I know, for example, the lower the week is most likely to be put in on the Monday or the Tuesday if we're going to have a bullish week. So that would mean that Monday would be my most successful day if I'm catching that low of the week and I'm a trend follower, so I'm running it to the Friday. Okay. Whereas a mean reversion trader, if you're trying to fade everything on a Tuesday, when you know that that's when the low of the week is going to be put in, or there's a higher chance of it, and I'm trying to short that market because of whatever reason, I know that I'm already up against it, because the probability of the market having some form of mean reversion is unlikely. So you have strategy specific things which might make certain days of the week better than other days of the week. But the more interesting thing here is the second side, which is where the funny stories come into this. And I actually didn't realize this side even existed until I started delving into this with certain traders. And it's the personal life, or the relationships that they have, or the routines that these traders have. And the two examples that made me realize this was, I worked with a trader who he had a great record, or at least it was good. It could have been great. And what we noticed was, All of his days were positive, except for Friday, which was, there was a big discrepancy between all 4 days of the week compared to a Friday. And we tried going through his past trades. We tried comparing his Friday trades to the middle of the week trades. And I mean, we noticed his setups just weren't up to scratch. Like, we could tell that from looking at his trades. But we tried to understand why he was taking these trades. He was super consistent throughout the week. Then on a Friday, he would always take a rubbish trade. And after many, many, many conversations, we realized that what was happening is this guy worked on a building site and he would finish work about 12 p.m., 1 p.m. In the afternoon. And what he would do, because we're based in the UK, so we've still got a lot of trading hours on that day, he would then go to the pub with his friends after finishing work early. He would sink a couple of beers. But guess what? The market's still open, right? So he would start trading, taking silly trades, looking at his phone whilst he was out in the pub with a beer in his hand. And he would start taking trades that potentially he shouldn't have been in. I don't even want to say potentially. He definitely shouldn't have been in those trades. And we boiled it down to that because we started looking then through his Friday trades. Okay, were you out this day or were you still working? Oh no, I was in the pub. Okay, so let's take a look at the time of this trade. Yeah, you was in the pub. You shouldn't have been in that position. It doesn't make sense why you're in that trade. And so what we did is we just enforced one basic rule, which to everybody else is kind of common sense, is do not trade when you're in the pub. Simple as that. If you're in the pub, put your phone in your pocket, forget about the markets. They will be there on Monday. Forget about it. The problem that this guy had was that he would take the trade on the Friday, most likely lose because he was taking, rubbish trades or low expectancy trades. And then he had a couple of days to think about it. Okay, so over the weekend, he would go, I can't believe I messed it up on Friday, but ready for a big week. Monday comes around again, and he's forgot all about that Friday stuff. He doesn't even remember that he was drunk in a pub and placed a rubbish trade. So he never learned from his mistake because he had the next couple of days where the market was shut and he couldn't he didn't have to confront it head on until I kind of told him, listen, you've got a problem. You need to stop trading whilst you're, sinking some beers. Since then, he stopped trading whilst, well, at least I think he stopped trading whilst he's at the pub, and his Friday is kind of leveling out a little bit now. So he's getting a better performance. The other funny one was, I say funny, it's not funny because we're talking about somebody's issue here, but it was funny as in like you wouldn't expect these kind of stories. I was chatting with a woman, and she had poor performance on a Wednesday. At least I think it was a Wednesday. I'm sure it was Wednesday. There was kind of a notable discrepancy between her Wednesday trading and the rest of the week, right? And again, we went back and forth, conversation to try and figure out what was causing this underperformance on a Wednesday in comparison to the rest of her trades. What we boiled it down to, again, going through individual positions, the time opening those positions, understanding what she was doing at this specific time. And what we figured out, and it became kind of like a light bulb moment for her when we got to this point, was Wednesday was the only day where she had to do like a late school run or something. So she was dropping her kids off to school on a Wednesday at this weird time, which meant it was the time where she would be trading the London Open. So what she would do is she would rush into trades before she got out of the house. Her focus wasn't fully there. And you could see that in her performance on Wednesdays. So again, it comes down to the simple fact of, if it's a Wednesday and you're about to go on a school run, don't take a trade. It's very simple. Don't touch the mouse. Just sit back. Forget about it. If you're not in the right frame of mind to execute, then forget about it. Now, I've just spent about 10 minutes rambling on about that, so I apologize. But I always think it's important because people look at this and they go, well, I don't really know what to do with this information. But you can audit it in two ways. You can look through your trades on a specific day of the week and understand, okay, does my edge present itself better here or there? For example, if you know that in this example, where Thursday is the worst performing day, it's the only negative day, there's a pretty big discrepancy between Tuesday and Thursday. Okay, there's about 4%. There's about 17% differential between Tuesday and Thursday. It's quite a big gap. Okay, so it's not very consistent. So what you can do is go through all of your trades, which I hope you have a trade journal with screenshots of all your positions in, and take a look at them. Is there anything that you're doing different on the Thursday to what you do on the Tuesday in terms of the time that you get into the trade, the way that the trade has formed visually, like any of these different things? Was there news on the Thursday but not on the Tuesday? Audit all of your trades at a very base level. If you can't find anything, take a look at your personal life. What am I doing on this day where I'm underperforming? And equally, what am I doing on the days where I'm overperforming? Because as much as you need to get rid of the time where you're not performing well, you need to replicate the success when you are a high performer. Okay, so I'd be looking at my Tuesdays and going, is this just edge specific? Is it a data anomaly where this will level out over time? Or is it something that I'm doing personally? Edge wonk, gonna check. Yeah, I mean, perfect. Go through all of your trades on edge wonk, audit them with a fine tooth comb. I don't think traders understand, especially discretionary traders, how much a journal will tell you about your own trading. Like we're scratching the tip of the iceberg here. We're looking at these metrics, and the reason I say that is because we don't have access to all of your trades. Like I can't see from the front end the trades that you're in, whereas you have that information. Okay, so this is very basic information in terms of I know, for example, how long you hold a trade, but I don't know what trade that was, whereas you do. So you've got to perform these self audits. 317 trades, 51% long exposure, which is great. You're not too heavy on the long side or short side. Daily trade frequency 1.97, 41.32% win rate. However, you have a fantastic payoff ratio of 1.87, which effectively, for the people who don't know, its payoff ratio is your risk to reward. So you have an average risk to reward of pretty much 1.9 with a 41% win rate, giving you a profit factor of 1.31. As we can see, your average winning trade 0.75, losing trade 0.4%. And you also have a positive duration ratio of 1.83. Now, I love it when a trader has a positive duration ratio, purely because, or I should say, a discretionary trader. Again, it's different for algorithm guys. If you have a positive duration ratio, it tells me two things. It tells me you know to cut losers short and you know to hold losers for longer time. So if we take a look at this, your average losing trade duration is just under 3 hours, which your average winning trade duration is about just under 5.5 hours. So that tells me that when you're in a loser, you don't hold on to it hoping that it's going to turn around. You cut the trade and you move on. However, when you're in a winner, you're happy to let it run for far longer than you are a losing trade. Okay, and quite often that can trip people up, and again can show you if there's any psychological issues that trader might be experiencing. If they have a really low duration ratio, it can show that as soon as a trade goes into a profit, the trade is going, oh, I need to get out. I need to bank this $100 or $200. But then when they're in a loss, they'll be like, oh no, it'll turn around. Or I hope it turns around. If you ever say I hope as a trader, yeah, you need to check out on that trade. Better than the worst said, interesting. I didn't know that about big traders. I had the S&P 500 and Tech 100 staring at it for 10 years. It's really true. It's only now that I feel comfortable. I'm a slow learner. I mean, yeah, everybody has a different way of doing things, right? Everybody has a different approach. Everybody has their own unique styles. I just find when I talk to bigger traders and guys with more experience, there's common things that pop up time and time and time again. And those are the things that the messages that keep getting repeated, those are the things that I take note of. If it's like a unique thing where some guy goes, oh yeah, I do, I attribute all my success to dunking my head in a bowl of ice water in the morning, but then somebody else goes, well, I don't do that. I'm like, okay, well, that's not really important to me. But if both of them tell me that, they measure the ATR of the trade that they're in, then of course I'm going to start listening to that. If it's a message that gets repeated by all of these successful traders, I'm going to absorb that information. That's kind of the hard part, especially when information is so easily accessible these days. You go onto YouTube or Twitter or X or Instagram, and you instantly get access to thousands and thousands of traders. So it's hard to decipher what do I listen to or what do I do here, because you get these stupid threads from idiots popping up going, I've made 10K this month. Here's exactly how I did it. Don't do this, do that. Don't do this, do this. And I'm like, well, great, that's worked for you, but I am not you. I can't take your exact genetic buildup and try and implement it myself. It's never going to work. You have to find the nuances and the things that work for you as an individual. Risk 1%. He is here. How we doing? Agreed. I always used to hope. Yeah, hope's a dreadful thing when it comes to trading. I mean, you should always be hopeful, right? But you should never hope that a trade is going to play out. BOFH, can you explain the purpose and usage of monthly rotation? Yeah, so I mean, I don't think there's necessarily a usage for it, but the monthly rotation shows how much volume you're turning over on a monthly basis. You can judge it to see if the trader's activity is higher or lower than it has been in the past. Sometimes it's good for looking at periods of time where, again, maybe you were underperforming or overperforming or something's changed. You can check the rotation. Okay, well, are you putting through the same amount of volume as you did while you were performing well? I don't look at it too much, to be honest. I can probably come up with ways it can be used, but I'm not too concerned about that as a metric, to be fair. But yeah, essentially measures your volume on a rolling basis. We'll go through these on Darwinex. Oh wow, you have a very, very high value at risk. Yeah, we need to cover that. Okay, let's move on to Darwinex. And the reason I'm doing this is because we have those metrics all available on Darwinex, but because we've got the stream open to the Darwinex guys today, I'd rather do it on the Darwinex platform as well. So for those that are unaware, you can view your zero Darwins on Darwinex.com. You have to be signed in, but you can use your Darwinex Zero username and password to log in. I just have a different account, but you can log in using your Zero account, and you get this same sort of interface that the Darwinex guys have. All the only difference is it says buy zero up here. Now, what we have over here is investable attributes. Again, some of these are already on zero, which we'll go through, but there's some unique ones on here as well. And I think every trader, when they're taking a look at their record, should look at both. For example, there's things on here like your capacity, which isn't available on zero. And I think it's super, super useful to know this stuff. So the first one is experience. Okay, and you have a 4.4 rating out of 10. They're all marked out of 10, and they do show you what they measure if you hover over the attribute. The problem with experience is it is what it says on the tin. This stat only builds when you gain experience. Experience is time plus trades. Okay, that's simply it. To get a better score, just keep trading. This doesn't really deter investors. Like, it's not something that an investor would look at and go, "Oh, this guy's got a low experience score," because they understand. Like, if I'm investing into a Darwin and they have a low experience score, I just understand that means they've only been trading with Darwinex for a specific period of time. But there's nothing to say that this guy doesn't have a 10-year record outside of Darwinex, or, you know, it's not a measure of ability. It's just saying, it's us saying as a company, I guess, we don't have enough data on this trader to say that accurately over the next 5 or 10 years, their results are going to look the same as the past 2 or 3 months. Okay. So when you first start, your experience is going to basically be zero. We measure it in D periods. I won't go into what that is now, but you can see you've got 1, 2, 3, 4. You're on your 5th D period. So it's basically looking at the two factors I said, the time and how many trades you take, to get an accurate representation of how you trade, or at least how consistent your trading is. And again, that will just come with time. Market correlation. So we already know that you have a 51% long exposure, which basically means that you're long 51% of the time and short 49% of the time. As a discretionary trader, I would expect that. I would be worried if it was far skewed the other way. What worries me about that specifically is if somebody's had a massive rally in their P&L, and then you look at their long exposure and you see it's like 80%, and that they trade gold or NASDAQ. So you know that they've just been long gold and NASDAQ through all of the highs. And it's kind of like, well, that's great. You've made money. Fantastic. But what happens when it turns? Are you going to stay 80% net long in a bear market? Like, how do you adapt as a trader? And that's why we have the market correlation score, which you currently have a 9.9 out of 10, which is great. There aren't many traders that have a low score here, other than long only traders. Like, if you're a long only stock and ETFs trader, for example, and you just invest long term with no leverage, then yes, of course, you are going to have a poor market correlation score, or at least a poorer market correlation score. Just by nature of, you may be able to hedge the volatility against the S&P 500 in terms of, by investing in individual stocks, you might be able to get a better risk-adjusted return, lower drawdowns than if I invested into the S&P. but you will never perform the same way in a bear market as you will in a bull market. So your market correlation score will be lower because your performance is directly impacted by the market condition and what sort of market we're in. Rosendo said, is there a minimum amount of time required before you can see your Darwin zero in classic? Because I can't manage to see it. As long as it's not in the calibration phase, you should be able to see it. What you should do is, you need to log in first, then put Darwinex.com/Darwin/ your 4-ticker Darwin, and then put a hashtag at the end. Don't ask me why that hashtag works. I genuinely don't know. It makes no sense to me, but it's technology for you, right? Yeah. I'm not going to pretend I know the answer to that. Sorry, I was just sending a message. Okay, risk stability. This is what I wanted to talk about. Okay, so this is your value at risk. And I'm sorry, dude, this is going to be a bit of a hard conversation because I always say there's no good or bad value at risk. It's subjective, right? No matter what your VAR is, your Darwin is always going to be risk adjusted to 6.5%. However, the reality check here is your VAR is 73%. What we have seen since the inception of Darwinex in 2012 is that any trader who has a value at risk of 30% or above has an exponentially higher chance of blowing their account. That isn't me saying that if your VAR is above 30% that you will blow your account. And it's not me saying that if your VAR is below 30% that you won't blow your account. But it's me saying that we see an exponential rise in the percentage chance of the account being blown or a significant drawdown if your VAR is above 30%. And you might not blow your account, but I'm talking like 60, 70, 80, 90% drawdowns, something that's, basically unrecoverable. And again, I'm not saying that you will blow your account, but what I'm saying is from the data that we've reviewed, the chance or the probability of having that significant drawdown or blowing up the account is exponentially higher. So as this kind of like, I don't know if you've ever seen an exponential chart. So it's kind of like this. If we imagine this is chance of blowing account up to 100%, and this is value at risk. Okay, so it's very slow at first. So if we added a line on here, it might be 30%. Okay, and we see it's just gradual, and this is the probability of blowing up an account, and it's just a gradual increase. Nothing fast, nothing scary. As soon as you surpass 30%, it pretty much goes vertical. And every percentage value at risk adds a huge increase in probability of that trader having a significant drawdown or blowing up. So that's kind of my unbiased opinion of your value at risk. I don't say it to be kind of a negative Nancy or negative Nelly, whatever you want to call it. I say it to be a realist based on the tens of thousands of traders that we've reviewed over the past 13 years. What I would recommend for you is try and get this down as much as you possibly can. Do it. Take time to do it. So don't drop your position size in tomorrow from a 10 lot down to a 1 lot. That is the worst thing that you can do, because the risk engine will take a look at your previous 45 days as an average. It will also take your past 6 months trading behavior as an average, and it will compare those two. It will take them both together, compare those as an average, and then it will compare it to your current behavior. So what you don't want is those averages to kind of be ignoring the fact that you've dropped your risk. So do it steadily. If you're at 10 lots now and your target is to get to a 1 lot per trade, start bringing that risk down ever so slightly. So go 9.9 lots, 9.8, 9.7, and so on and so forth. And take a few months to do that. Like literally take 2 or 3 months to slowly bring that down. And the only reason I say that, I mean, you used to be below 30%. So I'm presuming that you've increased your size as well as adding new assets over time. You were pretty stable here. Like I would have been pretty happy with this, to be completely honest. Even though it was above 30%, like the stability is the key thing here. The consistency of your value at risk is way more important than whether it's high or low. But I would try and get it back down to this level again if you can. And the easiest way and the best way to do that is to just drop your position size in, but do it steadily. Don't drop it overnight. I've never traded MT4 or MT5. I want my position to be calculated before I take the trade. Like I need to know if I risk 100 points on trade, what might be my loss? What should I pursue with MT4 or MT5? So you can figure it out. There's lot size calculators that you can use, or position size calculators you can use to figure out your expected loss or expected gain on a trade. There's also plugins that you can download. So I know a friend of mine, I can't remember what it's called, something position size, but it basically embeds on one of his MetaTrader charts, and he types in his order there, or he types in the lot size he's going to use, and it shows exactly how much is at stake for those trades. I was the same. I always use CTrader. I preferred it as a platform, and CTrader tells you exactly how much is at risk. So going back to MT5 wasn't fun, but there's ways around it. I use a lot size calculator if I was discretionary trading, but you can, like I say, get plugins and downloads for it. If you need a link to that, let me know. Just jump in the Discord and send me a message. My name's Kieran. I've got an orange tick in the Discord, or you can message us on social media, and I can get the name of the software that he uses, and maybe you can check that out for yourself. But like I say, it will outline exactly the risk on those specific trades. Okay, moving back to JKTN. So yeah, goal in my opinion should be bring your value at risk down to at least 40% would be the immediate goal. Hayseed said, fantastic question. Do you have a guideline for percentage margin level, not free margin, but the margin level reading itself? We don't. I'll be completely honest. We don't have a guideline for that. I can see if we have one somewhere, but to my knowledge, there's not really, because we measure exposure in deleverage. So it might be worth doing some reading on deleverage. So it's kind of like a convoluted way of looking at the leverage open. So it's kind of looking at your margin, but we added D at the front because we're special. So it might be worth going on the Darwinex K base or knowledge base online and reading up on deleverage and understanding a little bit how that works. That might be the best guideline for you. But in terms of saying you need X amount of free margin or X amount of margin percentage open at any given time, there's nothing like that. Sid, he's here. How we doing, dude? 5 p.m., which means for you it's going to be 2 a.m. 2 a.m. is it? 1 a.m. maybe? I know it's late. Yeah, I know it's late, but I always know it's you when the pink hand sticks up. Okay, it's 5 p.m., but we're going to stay on because we've got a few more metrics to take a look at. 2 a.m. correct. This is the most committed guy, Sid, on, I'm presuming you're watching on the D0 YouTube channel. He comes to every single session that I run, and it's all at 1 or 2 a.m. for him. So massive big ups to you, Sid. You're getting it done. You're taking the value. I love to see it. So we have risk adjustment metric, which again, you're scored 9.8 out of 10. So great work there. This effectively shows how often the risk engine has had to intervene in your trading. So if you're unaware, the risk engine gets involved in your position at 2 times. When you open the trade, it will calculate the correct position sizing based on your value at risk and risk multiplier. But then it also monitors the position for the lifetime of that trade, right? So however long that trade is open, the risk engine is watching it. If the deleverage exceeds a certain threshold, again, going back to what I was talking about just with the deleverage, the risk engine can intervene and close a certain amount of that position to keep the deleverage under that certain threshold. Again, there's guidance on this on our knowledge base. I think if you go deleverage, Darwinex. In fact, no, it might be under risk adjustment, Darwinex. Yeah, it's not on that one. Is it on here? Here we go. So if you go on if you search for on the Darwinex K-base, the risk adjustment attribute, which is exactly what we're looking at now, and you scroll down, it tells you the deleverage that it looks for. If the deleverage exceeds X, what it is here, so 16.25, 13, or 9.75, based on how long you're in the trade, the risk engine can get involved and can close a certain percentage of that trade. So let's say if you've been in a trade for longer than an hour and the maximum deleverage is 9.75, let's say your trade goes to 10. Okay, the risk engine might shave off like 5% of that trade to get the deleverage back underneath 9.75. It does it holistically. There's no kind of reason. It's not against any specific trade or strategy or style. It does it based on the deleverage and the deleverage only. Just a question regarding this VAR talk. Why would one be concerned about what signal VAR is when it gets scaled down or up to 6.5%? Anyway, sorry if this was explained. Fantastic question. That is the best question that I've ever been asked, right? Because I usually spend every session talking to traders saying, don't worry about it. Stop trying to chase your tail by fiddling with your value at risk to get a risk multiplier of 1x. It doesn't matter because your Darwin will always be risk adjusted to the same level, regardless of how much you're risking a signal account. The issue is when you're above 30%, this is the only time that I really bring it up. When you're above 30%, the chance of blowing that account has an exponential increase in probability. The fact is, with this Darwin, it's over 2x 30% because it was like 73%. So why I say that is because if the trader blows up their account, regardless of whether it's through Zero or Classic or whether it's their own capital in whatever brokerage account, if your VAR is that high, you need to know the risks that you're taking to generate your return. And I never advocate for, like, especially on Zero, where it doesn't really matter, right? Because you're not earning from that. With Classic, I get it a little bit more. If you put 10 grand into a live brokerage account and you kind of adopt that mindset where you go, it doesn't matter because my Darwin will always be roughly 6.5%. So I'm going to flip this account. I'm going to try and get that 10K to 20K in the next couple of months. Okay, that's fine. It's your money. You do what you want with it, but you don't gain any benefit on Darwinex Zero, where that 100K simulated account or $1 million simulated account, it's not going to pay you. So it makes sense to lower the size. Make sure you don't blow up that account and ruin the Darwin. Andre says, I hope I'm pronouncing your name correctly, by the way, dude. Also, there is an other disadvantage when it's really high. Even I take maximum margin position that the Darwin. Yeah, exactly that. So because Darwinex as a broker is FCA regulated, of course our leverage is far lower than some random offshore unregulated broker, meaning that the limit is usually 30 to 1 on FX pairs and even lower. I think it's like 10 to 1 on gold and stuff, meaning that the margin required to put up for the trades is far higher. And as Andres says, if your value at risk is 70-something%, that would likely mean that you're using up all of your margin to put on a trade, which, again, there's no kind of advantage to that because you're not making money from that account outside of your Darwin. So I just don't see the point. And it's good practice to try and, scale back and risk a steady amount. Not being able to add more risk than 0.2%. Yeah, exactly that. Have you got a Darwin account to trade or just a Darwinex Zero account? Are you asking me that question, risk 1%? I presume you are because I'm the only one. I'm the only one talking. Jason said, I see. So this is more of a preservation of signal account. Exactly. I mean, your Darwin basically dies if you're well. I suppose it doesn't really, because if your signal account goes to zero, your Darwin won't ever go to zero, right? Because we would protect it from doing so. It will still go down. It still might go down 20-30%, what have you. But odds are you're going to want to restart that account. But even if you continue trading, your Darwin will continue trading. I'll show you an example before we move on. So this is an example I was looking at today. And this is just to show you the discrepancy between Darwin and signal account. So if we look at TRO, it's on 107% return. This Darwin has a low value at risk, so it is scaled up. But you can see how, let me bring up my pen. If we take a look at this, where is it popping up? Here we go. So if we take a look at this, okay, you can see it's moving higher. Okay, so there's this upward trajectory, okay? And this was a high from 2021. Yeah, it took, that was the dodgiest line I've ever drew. It took a couple of years to surpass that, but we did. So we've been moving higher on this Darwin. Now, if we look at their signal account, the underlying strategy, let me click all. Now, what do you notice? That same high from 2021 is still the high. Okay, and we've actually we've actually just been in a period of stagnation for the past few years. It's not really made any money. It's not been on an upward trajectory the way that the Darwin has. I don't really know how I got onto this this point, but this is just to say that, like, when there's so much that goes into the risk engine, right? And people kick up a fuss and I don't like that it adjusts my positions. I don't like that it changes my risk size. It can quite literally, and I've seen hundreds of these cases, it can quite literally take a stagnated account or a losing trader and turn it into a winning trader, right? Take a look at this. The proof is in the pudding. We're still not above those 2021 highs. If we then look at their actual Darwin, their 2021 highs was breached way back in January 2024. Okay, so and this is kind of the angle that I'm trying to push now, especially with zero. When people ask me about their Darwin and how do I change this, how do I get my risk multiplier up, I'm like, stop worrying about it, because your Darwin it's not just you, it's not just controlled or owned by you. It is your trades with the Darwinex risk engine. So we implement our risk management style onto your trades. And this is kind of proof in the pudding, right? How this trade. I'll give you another example. BLM. This is my favorite. This is one of my favorite examples. Yeah, Jay said, perfect example to show people who whine about how the risk engine is sabotaging them. Yeah, as soon as somebody says the risk engine sabotaging me, I just automatically know that they martingale trade. I automatically know that. So if we take a look at this, Darwin, I mean, just remember what this equity curve looks like. I don't even have to draw any lines on this. I mean, they haven't traded since mid-2024, which is understandable when I show you in a second. But they average like 10 or 11% year on year, 7-year record, I think it was, 78% return. So pretty decent performance-wise. Not the best, but also not the worst. Pretty decent. Take a look at their underlying strategy and put it to all time. They're down 4% over that same 7-year period. They haven't made a single penny. Now, of course, they've made money. Like, they were up 150% over here. Then they were down 63%. Then they were up again, 80% there, and then back down 70% down here. And they made money, lost money, made money, lost money. But there is no, like, there's just no stability here whatsoever. Okay, the variance of their account balance or equity is wild. We're talking a couple of 100%. And at the end of that 7-year period, they still hadn't made money. They were still down 4%. They were just, I wouldn't call them a losing trader. They were kind of, yeah, it does look like a MACD. I wouldn't say they're a losing trader, but they're clearly not a winning trader. But then you look at their Darwin, which again is their trades plus our risk management, and it looks like a winning asset or a winning trader, right? I mean, not the best trader in the world, but we've done the best with what we've got. And so I just think it's really important to know that when we're going through the risk adjustment metrics and all these different things, I'm going to talk about the stable value at risk and not to worry about your risk multiplier. This is the perfect example, or these are the perfect examples why I say these things. The risk engine isn't out there to hurt anybody, and anybody who has spent a significant amount of time on Darwinex, let's say 1, 2 to 5 to 10 years, will always say, I love the risk engine. It's the people who've been here for a month or 2 months that they go, I don't understand it, therefore I don't like it, which is a really bad mindset to have. Whew. Anyway, enough rambling on about that right now. Let's move back to risk adjustment. So you can see there's some red dots. That's where the risk engine has got involved and shaved off some of the positions. But you can see over here, there's only 3.6% of exposure that's been closed. So there's not a lot. Right. It's not as if all of your trades are getting shut early or anything like that. It's usually a small percentage of, there's not much in there. But you'll be able to take a look at individual trades and when any adjustment was taking place. The next two, open and close strategy. I'm going to suggest that you read the knowledge base article on this again. Open, close strategy, Darwinex. And the reason being is because it's a custom built metric. So Javi Colon, the founder of Darwinex, or one of the founders of Darwinex, built this as a unique metric. And I always butcher my description of it or my explanation. So you can go onto the Darwinex K-Base, which is fantastic, by the way. If you ever want a bit of, weekend reading, just go to the Darwinex K-Base and read some of the articles on there. But this will tell you exactly what it does, and I'll give you kind of the brief overview, if you will. It measures using a time-based metric how you could improve your entries and exits using time. So where you can see on the chart here, you can see there's 10, 20, 30, 40, 50%, and minus 10, minus 20, minus 30, minus 40, minus 50%. It shows you which is the most optimal for your strategy based on the data that we have. So would it benefit you by entering the market 10, 20, 30, 40, 50, or minus 10, 30, 40, 20, 50% before or after you do? Again, I'm probably butchering the explanation, but essentially, if my average trade time is 10 hours, would I be better waiting 2 hours, which would be 20% before I get in the market? It doesn't benefit everybody. You know, it's not. For example, if you set limit orders, sometimes this might be not well. Actually, I suppose that's probably the perfect example, because if you set limit orders, but you can see from this, you're better to wait 2 hours. Maybe you wait till your limit order level is hit, and then you wait for 2 hours and then execute, for example. Same with your exits. The easiest way to utilize this information, I think, is when you have a huge maximum favorable excursion, which we'll get onto in loss aversion in a moment. And you can also see that you would outperform your current exit strategy by holding trades for longer. You can kind of pair the two, knowing that your maximum favorable excursion is X percentage or X amount of pips, points, or dollars, what have you. And you know that if I hold on to my trades for 20% longer, which could be 2 hours, 4 hours, 10 hours, who knows, then I would make more money. Then you can start building a plan around, okay, I'm going to extend my targets. I'm going to try and run trades for a little bit longer. Sorry for derailing the conversation. That's all my questions for today. Nah, no problem, dude. I mean, as I say in every one of these sessions, without you guys, I'd just be a weirdo talking to a camera. So I appreciate all the conversations. Risk 1%. Yes, I did used to have a Darwin account, but now I just have my portfolios on zero. Main reason for that is because for my portfolios, I need a larger amount of margin, and I don't have 100K to stick in the bank. I don't have 100K that I'm willing to put in a brokerage account now, when I can, you know, get an account through Darwinex Zero, and get the same sort of infrastructure, if you will. I do also have an investor account with Darwinex, mainly for the index. But yeah, I think I don't know. I prefer Darwinex Zero, but that's because I like to add. I actually prefer Darwinex because I think Darwinex is a better offering in terms of you can make money on your own money. However, I prefer Zero for my specific situation where I'm building portfolios and testing them out, because a lot of my live testing I do on Darwinex. And so I don't want to stick 100K into an account, or 50K or 200K, however much the margin is required for my portfolio to run. I don't want to stick that in to test it, right? So yeah. Moving on. We've already looked at positive, negative, and oh no, we haven't actually. No, we haven't. So this is a chart. It's got squares on Darwinex Zero, but it shows the same information, and it effectively shows what your average return is based on how long you're in the market. Now, going back to the conversation about expected value, this is a great way to find where your kind of hot zones are. So if you're a scalper, generally what you'll find is there's more circles down here or more squares down there on Darwinex Zero. And you'll find that the majority of your return is under 30 minutes, let's say, and that's where you make the most amount of your pips. What you can start to do is count how many trades are there. Let's say you win 80 trades within a 30-minute time window, and you've lost 20 trades. Or no, yeah. So you know at that point, you've got like an 80% strike rate. Out of 100 trades, you've won 80, you've lost 20. Okay. Now, when you go into the next time frame, which might be 30 minutes to 1 hour, if you've got 50 losses and 50 wins, where you go, my expected value changed now based on how long I've been in the market, because up until 30 minutes, I won 80%, lost 20%. Now I've won 50%, I've lost 50% of my trades, considering there's another 100, let's say. Now, when we go from 1 hour to 2 hour as the next time window, now let's say we've won 10 trades and we've lost 90. We go, I've got a 10% win rate here. My expected value is, fallen off a cliff. So you can start implementing things like time-based stops. okay, or time-based exits. If you know that your expected value diminishes the longer you're in a position, the longer you hold that trade, what's the point in holding it for? Yeah, you might get that winner, but if you know there's only a 10% chance that you're going to get the winner, does it make sense to? Or does it make sense to cut your losing trades earlier? It's unique for everybody. Swing traders, of course, their hot zone isn't under that 30-minute mark. It might be the longer that they're in a trade, the higher their expected value. So if you've got an issue with holding trades, like if you've got a psychological issue and as soon as you see some profit, you want to close it, take a look at your duration consistency, or on zero. I'll show you the chart on zero. It's under the strategy analysis tab. It's this one, duration versus profit. A little bit easier to see when you're looking at it on zero, but it shows the same things. One of my favorite metrics in the world is what we call loss aversion, but actually it's your maximum favorable excursion and your maximum adverse excursion. And the reason it's one of my favorites, and I stand by this to this day, is I think this is one of the only metrics that you can take a look at as a trader that can turn a losing or break-even trader into a winning trader without having to change anything strategy specific. Now, what I mean by that is if you study your maximum excursions and your average excursions, you can adopt your strategy and change your targets, your entries, your stops to be more suited to the market that you're trading. You don't have to trade any of the criteria for you to enter the position. You don't have to change anything from the management perspective. So your strategy remains the same. Everything is the same assets, timeframes, same strategy. All you're doing is taking a look at your entries, your exits under a microscope, basically. So for those of you that are unaware, your maximum adverse excursion, or negative excursion as it's labeled on Darwinex, is how far the trades move against you before they move in your favor, right? Which is the red side of these candles. Your maximum positive excursion, or favorable excursion as I know it as, is how far the trades move in your direction, okay? So the green side of these candles. The reason these are important, and I also think you should track this outside of Darwinex as well, because any automated software like this will only be able to track it whilst you're in that trade. So if you close a trade for 100 pips, for example, but then it runs another 100 pips, it will show that 100 pips was your MFE, but actually your MFE might have been 200 pips. So it's good to know outside of your trade, okay, once I've closed it, then how far did it run afterwards? The great thing about that is if you know that, let's say you use a fixed target on every trade of 50 pips, but you find that your average maximum favorable excursion is 75 pips, well, guess what? You're leaving 25 pips on the table on average every single trade. Extend your targets. It doesn't have to be by 25 pips. Maybe you can extend it by 10, 15, 20. But any of that, like that change will massively, massively increase your expected value without having to do any sort of change to your strategy other than increasing your targets, taking more on your winning trades, okay? On the flip side, your maximum adverse excursion is also a fantastic metric because it measures how far your winning trades go against you before they turn into winning trades. The reason why that's so useful is because let's say I'm entering here with a 20 pip stop and a 30 pip target, for example, and I know on average my trades go against me by 10 pips, or my winning trades go against me by 10 pips. Well, great. I can move my entry down. I can get a tighter stop. If I know that all my trades go against me by 5 to 10 pips, well, I'll move my entry down by 4 to 5 pips so that I still try and capture as many of the trades as possible, but I'm getting a better entry on my winning trades. The other thing that you can do is on your winning trades, if you know that the maximum negative excursion was 20 pips, but you have a fixed stop, for example, and I'm using fixed stops because it's an easy way to explain it. But if I have a fixed stop of 30 pips, right, on every single trade, and the maximum negative excursion I've ever encountered was 20 pips, well, guess what? You've figured out that you're risking 10 pips too much on a trade. So you can cut that down. Just move your stop to 20 pips. And because of that, you'll be able to get 30% more position sizing on that trade, meaning that your risk to reward is massively boosted, meaning your expected value is massively boosted, all from playing around with stops and targets whilst not really diminishing your win rate or your expected value from that perspective, and not even touching your strategy. I think it's such a powerful tool that every trader should take a look at, or not tool, but metric or statistic that every single trader should take a look at. Understand how far your trades move, how much of the market can you capture. For example, I have an inside day strategy that I run on multiple pairs in my portfolio. I know the win rate of that strategy is about 80 to 82%, regardless of the asset that I run it on. The only thing is my maximum, my MFE, or my maximum positive excursion, is very, very small. So whilst it's got a very, very high win rate, I know that I can't be targeting 100 pips or 2x ATR or 2x the previous day's candle. I know it's a small move, so I target a small move. But I measure how far these moves go, okay? And then I know how much I can target. Do the work, because again, this is the one thing, it can completely change your strategy. This is the one that if there's a trader who's stuck at break even, the first thing I always suggest is go and check your MFE and your MAE. Then we'll talk. When you come back to me with that information, then we'll talk. If they're break even and they've already optimized this, then maybe their strategy isn't up to scratch, and maybe there's some things that need changing. But it's the first thing that I always tell people to go and take a look at. Okay, last two now before we call it a session. So we have the performance tab, and essentially this is like a Monte Carlo test. So it runs your strategy against 10,000 random strategies, all running at the same risk level. Just to give you a bit of an idea as to where you are performing against randomized outcomes. So you can see JKTN is currently on the 98.8th percentile, meaning that effectively you're outperforming 9,880 strategies that would be operating at the same risk level as yours. The reason I like to look at this and like to use this is because if I make a big change to a strategy or to my portfolio, you kind of get instantaneous feedback. Okay, if something big happens, you're going to probably drop through the Monte Carlo. It gives you instant feedback. What's happening? Is the changes that I made useful? Is it not useful? Should I revert the changes? Should I increase the output? If you start adding new assets, for example, and you shoot through the performance of the randomized outcomes, great. You know what you did was the right decision, at least in the short term, but then you can keep monitoring it. It does basically follow your equity curve. So the more money you make, the higher the performance is going to be, of course. So it is very P&L based, but I like to monitor it just to make sure that what I'm doing is kind of the right thing to do. And last but not least, the most interesting one is capacity. The reason I say it's interesting is because not a lot of traders, especially beginner traders, think this is going to be a problem. And generally, it's not. For a lot of traders, it's not always a problem. But when it is a problem, it's usually too late. So if capacity is an issue for you, usually it's when you only figure it out when it becomes an issue, i.e. what I mean is every strategy or portfolio has an alpha cap, meaning that there's a maximum amount of capital that strategy can handle because of liquidity constraints and toxic order flow and all of these different things. So for example, if I'm trading illiquid pairs through the Asian session with a 2-pip stop, I'm probably going to be able to manage about 10K before my investors start getting blown out by spread or slippage. So what we do is we would cap your strategy to specific amounts of alpha cap or max investment. And we do that by measuring your toxic order flow and then understanding by looking at that flow, what is the discrepancy that an investor with X amount of capital would experience based on the amount of pips that they would get slipped based on your toxic order flow. So if we take a look at this chart at the top, it shows you what would be the discrepancy between an investor and yourself if they were getting slipped X amount of pips. So you can see that this Darwin is up 21.74% this Monday just gone. So I think it updates every Monday. But if an investor was slipped 2 pips on every position, I believe on entry and exit, then the investor would be down 11.15%, which is like a 30% differential. Okay, so we can't advertise your strategy to every Tom, Dick, and Harry say, come invest here, and then blow through your alpha cap, because we know that an investor then will be getting a losing strategy, essentially, and they're going to lose money on their investment. As an FCA regulated asset manager, we just cannot allow that to happen, of course, as you can imagine. Hence why we put caps on Strategies. So if we scroll down, we can see maximum estimated investment in the Darwin, and yours is rising nicely, which is fantastic. But it's currently sat at 15.2 million. So I don't think you'll have an issue with that personally, especially because you're a discretionary trader who doesn't, trade too much. Like if you get to 15 million, then yeah, it's going to become a problem. But usually this is only a problem when someone's alpha cap's about 200 to 500K, because they go, what? I've been managing $1 million in funding capital or prop firms for the past 2 years. How's this an issue? And we go, well, yeah, it's fake money, right? You're putting no orders through the market. There's not really an investor sitting through your 2-pip stop loss trades on the M1 time frame, right? And when you have a good investor, you can fill up at 500K or even $1 million fairly easy. So at 15 mil, you're probably not going to have an issue. If you get to 10 million in the next couple of years, then that's when I'll be going and investing a little bit more time, probably getting some external advice from quant teams and stuff on how you can optimize your strategy to increase your maximum investment. I can't give you that advice because, to be honest, it's different for every trader, but it's very commonsensical things such as, do you trade liquid assets? Do you trade at liquid times of day? Do you trade with big enough stops so that your trades can breathe? What I mean by that is, if I trade with a 10-pip stop, okay, and my investor gets slipped 2 pips, they're getting slipped 20% of their position, which means they're paying up 20%. If I have a 100-pip stop and they get slipped 2 pips, they're paying up 2%. It's a massive difference. They're getting slipped the same amount, but they're paying up completely different amounts relative to the size of the stop. Holding trades for longer as well, like that helps. I don't know why that helps necessarily, but I think it's just about the frequency of getting in and out of the market and the risk of slippage and stuff. But again, if you want to read more about that, we have a massive article in the K-Base about capacity where it goes into all of these different metrics and the capacity and all of the different factors that affect capacity. But again, it's very unique to each individual trader. So I can't say something now that benefits everybody because it's different for everybody in the way that you trade. Andre says, Kieran, this was very useful for me. Thanks for your time and your knowledge. Appreciate tons. I mean, it's a pleasure, dude. Like, I love doing these sessions anyway. Like I said at the beginning, I was a data analyst. I'm a trader now. I'm now an algo trader. So like this sort of thing and looking at patterns in different variables is a bit of a nerd thing to say, but I just love doing it, right? So these sessions are my favorite sessions to run on a weekly basis, bar none. And it helps. I mean, our average attendance to these sessions is usually about 80 to 90 people, and we've got almost 700 people on the stream right now, which is absolutely fantastic. And I think that's because I've opened it up to Darwinex. I think just before I went to go live, I was like, oh, I've got the ability to stream to Darwinex as well as Zero, so I may as well try it, right, and see what the intake is like. And I mean, well, proof's in the pudding. We've got almost 700 people on the stream, so it's been absolutely fantastic. But guys, I am going to call it a session there because of 2 reasons. I've drunk a lot of this today. I drunk a lot of water, so I definitely need a toilet break. And then my kids are home, and I need to go and make us all some dinner because family time is what it's all about, right? So it's been an absolute pleasure to be on here today with you guys. We will be back tomorrow for a session on the risk engine. So we will take a look at all of the things about value at risk, the risk multiplier, how the risk engine intervenes in your strategy, all of that sort of good stuff. It's kind of more of an advanced session than all the other stuff that we do. I mean, I guess this is advanced to a degree, but it's more looking at Darwinex in a higher level, or looking at the risk engine in a higher level. Moeen said, I love these sessions, looking forward. Awesome. Glad to see it. And thank you for sharing the session earlier. I did see that at the beginning. Jason, thank you for your time, mate. It's a pleasure as always. You need to go and get some rest. Guys, I'm going to love you and leave you. Thank you all for joining. Thank you everyone for your comments. Andrej, thank you for sharing your time with us and letting me go through it today. It's massively appreciated. If you want to join the Risk Engine session tomorrow, it will be streamed from 4 p.m. UK time. And if you want to watch this session back, it will be on both the Darwinex and Darwinex Zero's Twitters and YouTubes for you to go and view at a later date. So guys, have a fantastic rest of your afternoon, evening, morning, night, wherever you're based in the world. And I will catch you tomorrow in the next session. Peace out, guys.